The last few times that I have rented a car, tried to book a hotel, or looked to buy airline tickets, I have been incredibly frustrated about the hidden fees and the additional surcharges that inevitably are going to come. I just want to know what the cost is before I book it. It's really frustrating to see a great deal, or what I think is a great deal, on an online booking company, and then the next thing, it's 3 times that rate.
Sure.
I don't like hidden fees. I don't like hidden charges.
Right.
They're frustrating.
Yeah.
And as we think about beneficiary designations, and as we think about passing resources on to the next generation, I don't think that many of our listeners want to leave the IRS a substantial hidden tip.
Yeah.
So, Spencer, as we think about beneficiary designations, as we think about passing on resources, what do we need to know? How do we pass on it efficiently, both to get the most to our heirs, but also not to leave the IRS a nice big tip?
Yeah, so as we think about this, what is standard again in our culture oftentimes is we look at it and say, okay, I'm going to put together my will, and if I'm married, my spouse is going to get everything, and then if I have children, we're going to divide up the entire estate just pro rata across that number of kids.
Yeah,
basically. And this logic has moved also to, say, IRA beneficiary designations, 401k, other kinds of accounts there as well, where we say, okay, well, I have 2 children, so they're going to get it 50-50 after my spouse does. But what happens oftentimes is, unwittingly, we are naming the IRS as one of our beneficiaries at far higher an amount than we need to.
Yep.
So with a little bit of acumen, logic, consideration, what happens oftentimes is that we can change that dynamic some.
Yeah.
And that's what we'll dive into today as we think about these beneficiary designations and think about how different types of accounts are taxed in different ways, and ways that we may be able to just have a conversation across the family to say, this is actually going to be best for everybody if we can, get behind this strategy particularly.
Yeah. So we talked before in previous videos that not all accounts should be used for the same goals. You need to have goals that match your accounts. Similarly, we need to have beneficiary designations that match the beneficiary.
Right.
Because again, it's really helpful to think about, okay, what is their current situation? What is their future situation?
Right.
And how do we maximize getting resources to them?
Right.
Because again, we don't want to leave the IRS that unnecessary tip.
Right.
So, good start. What are our different types of accounts that we can utilize when we're passing on resources?
Yeah, so they're the accounts, of course, that we're saving towards. We could think about this broadly in a number of different categories, but the first one, I'll touch on 3 basic ones, and then we'll come back to first one that we'll dive into. You can think traditional IRA, 401k, pre-tax resources. We've not paid tax on them. We've just saved in that direction.
Yep.
If we pull resources out, unless they go direct to a charity, we're going to pay some tax on that, and our heirs will as well.
Yep.
Talk about that in a moment. We have the Roth resources. We paid tax on them up front. And so we can see tax-free growth over time when we pull them out or our heirs pull them out. No tax on them, provided that they're qualified distributions, which generally they are if we're being careful about the ways that we think about that. And then that third piece is non-qualified resources. This would be resources that don't qualify for any tax benefit, like saving towards a retirement account or anything like that. So an example would be an after-tax account here where we invest in stock in one company and we see it go up over time. This is going to have different tax considerations for passing on to the next generation than either of these retirement account pieces. So we'll dive in there, and that'll be the first place that we go. Because when we look at those non-qualified resources, if we have a non-qualified account, and whether this is an individual account that just one person owns, or it's a joint account that maybe 2 spouses hold together, that non-qualified account, you're going to pay taxes annually on the dividends that you receive, any kind of capital gains that you harvest, any interest that comes in, from that account. So that's what a non-qualified account is again. Now, if we think about the way that this relates to estate planning, let's say you've had one of these accounts for a long period of time.
Yeah.
Then the considerations are quite different there in terms of how you pass on resources, because there's this step up of cost basis. So, we'll talk about this fictional example of our Uncle Joe here.
Yeah.
And so Uncle Joe made a really wise investment many, many years ago. And the stock price, and we'll call it company XYZ here, but stock price of company XYZ at the time was $10 per share. Over time, it grew to $100 per share, and he passes away. Now, he has 1,000 shares that he wants to pass on. So again, the beginning value, $10,000, we'll say that there were no dividends that were paid, so there wasn't a change in cost basis, there via the dividends through the course of his lifetime. At the end of his life, that's worth $100,000. Now, at his passing, as of the date of his death, if he passes those resources on to you, then there's a step up in that cost basis. So the $90,000 of gain that he had from making a $10,000 initial investment all the way up to $100,000, that's wiped out.
Yeah.
That cost basis steps up on the date of his death. And so his beneficiaries basically get an asset that doesn't have any tax consequences associated with it.
Right.
So it can be very, very beneficial to them, particularly if they're at a much higher tax rate.
Yep.
Now, the converse would be, let's just say he had an IRA, he had $10,000 in it, it grew to $100,000, he passes that on. Well, now when his beneficiaries take the distributions, it's going to be included in their ordinary income over time, unless they do something like a qualified charitable distribution, which would be unusual in a beneficiary IRA. So, Austin, other thoughts that you've got, around that non-qualified area of how we think about planning for those non-qualified resources?
Yeah, as we think about those non-qualifieds, and there's ways that we can encourage clients to do living and giving while they're alive.
Yeah.
Now, if you wanted to pass on non-qualified resources, let's say Uncle Joe wants to give you that stock, and he wants to give you the value of that stock. Well, there's a couple of methods he can do it. He can do it at his passing.
Yeah.
But let's say he were to do it while he's alive. He decides, okay, I'm going to liquidate the shares and I'm going to give you that cash. Well, if he does that, then he has to harvest the capital gains of that $90,000. So he has to pay tax of roughly $13,500.
Right.
So then Uncle Joe now has to decide, do I want to pay the tax and still give that $100,000 gift? Well, now he has to have that $13,500 to pay the capital gains if he's at a 15% rate. And then pay that extra to be able to give you the full 100.
Right.
Or he just gives you $86,500. Either way, it's a very substantial and a generous gift. But as you think about that, that's a consideration. If you want to accelerate that living and giving, you can do that. But that may be a situation where you allow the step up in cost basis.
And the flip side there is sometimes we'll even encourage clients, if they're thinking about gifting shares maybe on down to the next generation and someone that's in college, but able to file taxes, file for their own tax return via different circumstances. Sometimes we can wipe out pretty significant gain there because you're not taxed on gain up to a certain amount there. So if you have a very low income, sometimes instead of Uncle Joe, they're selling the shares, giving the gift. He might be able to just give the gift of the shares, which the cost basis comes over. So you have that gain to deal with, but because maybe you're just right out of college or something like that, and your income is fairly low, maybe you don't have any tax on that.
Right.
So there are different ways that we can sometimes manipulate that, such that even gifts during lifetime can be advisable.
Yeah. And similar with those capital gains, if Uncle Joe decides, I don't want to give it to an individual, if he wants to give it to a charity, he can give those resources directly to a charity and not harvest the capital gains himself.
Right.
So there's lots of different ways that Uncle Joe can use those resources that he's seen grow, that he doesn't want to pay tax on, to give to loved ones or institutions and allow for the capital gain not to be realized by himself.
Right, and that's an important point because if he makes those gifts during his lifetime, then he's actually going to get a tax write-off on his income, up to 30% of his income, in a given year if he's got gain, in those assets.
Right.
So oftentimes, if we're thinking, okay, do we give now or do we give at the end of life? It can actually be more advantageous to give to the charitable institution now or put those resources into a donor advised fund because you get the tax write-off during your lifetime. And there may not be any benefit at your passing. There may not be any tax for your estate that that you could really write off through that gift.
Yeah.
So Austin, as we think about planning with respect to Roth IRAs, what's different? How do we think about that in terms of beneficiary designations and end-of-life decisions there?
Yeah. So with Roth IRAs, there's one really important consideration to think about before you name your beneficiary. And you have to think about how long has the Roth IRA been open? And really, this is for the beneficiary, I guess, more than the donor. But as long as the account has been open at least 5 years, any distributions that you take of the earnings are going to be tax-free. You can always take the principal out without a tax penalty. But if you take them out within that 5 years, first 5 years after the account is opened, well, then there's going to be tax on those earnings. So you really have to think about any sort of a distribution plan on your Roth IRA with that first limitation in mind. Has this account been open within the last 5 years? Once you, again, cross that 5-year threshold, you're in a good state. So the other thing we want to consider between the Roth and the traditional IRA is maybe doing some tax planning, because if you've got multiple people that you're naming as beneficiaries between your Roth and your traditional IRA, well, let's say I have 2 children. One is in a high income bracket and one is in a low income bracket. Well, if I pass on traditional IRA resources to someone that's in a high income bracket, well, they're going to have to pay tax on it. Do I want the IRS taking a 20, 25, 30% cut if my heir is in a high income tax bracket? Not necessarily. So maybe I put Roth resources and give those to my high income earner, where maybe that lower income earner gets the traditional IRA, where they're not going to be taxed at such a high level.
Right. And we understand that families are really going to look at this from a fairness perspective, but a lot of the estate planning attorneys that we've worked with have put some kind of clause in the will, actually, that says, okay, the executor or executrix has latitude to be able to equalize the estate after some tax pieces, get put in place there. So let's just say there's $500,000 in Roth, $500,000 in traditional IRA. Even though the income is less for that lower income earner, they're still going to have some tax that they pay on that IRA. But that can be worked out in terms of where these other resources go. Yeah. So there's enough latitude there that we don't just have to go 50-50. Let's say if we've got 2 heirs, or 25% apiece if there's 4 heirs.
Right.
There's other resources oftentimes, whether it's a home or bank accounts or what have you, where we can kind of balance things out, doing just exactly what you said, Austin, there in allowing the executor to make that decision.
Yeah. So as we're thinking about actual distributions, so once an IRA is inherited, we're going to talk about a Roth IRA. There's a couple options that you have. If that's been open for 5 years and you want to just take the lump sum, you can take a lump sum distribution from that Roth IRA. There's nothing stopping you from doing that. If you want, you can give it a 5-year clock, take no distributions, and then after 5 years, take it all. The last is you could do it over a 10-year time frame. If you do it over that 10-year time frame, you've got to take distributions every year and then have that account liquidated at that end of the 10-year period. But all that to be said, with a Roth IRA, if you're a beneficiary of a Roth IRA, there's some opportunity sets that you have to take those distributions.
Right. And oftentimes, if you don't want to take the distribution, if you don't need it, then what you want to do is take the smallest amount, for that first 9 years, let the account grow as much as it can, tax-free, and then take everything else out the 10th year.
Right.
Now, if we go back in the Wayback Time machine, circa 2019, you may be saying, I thought I could stretch these distributions out over the course of my lifetime, but it was the Secure Act, I should say. We just had Secure 2.0 recently, but the Secure Act that changed that, where now you've only got 10 years, as Austin spoke about. So that is a change, and we've tried to address that with clients who may be looking at their estate plans differently now, but that's something that is fairly new in the landscape of planning.
Yeah. And we will say, these are if you pass resources on to a non-spousal beneficiary. Spousal beneficiaries are different, but a non-spousal beneficiary, that's where these considerations come into play.
Right. Spousal beneficiaries, typically you're still just on that same path of required minimum distributions based on your age. If you have a traditional IRA, 401k, and then, of course, Roth resources, you don't have that same required minimum distribution. So now let's dive into the world of those pre-tax resources, that
Great.
traditional IRA, traditional 401k, 403b, those kinds of resources where you saved during your working years, typically, didn't pay tax on those. You've seen growth over time, hopefully, and then you're taking resources out. You want to pass those resources on. Well, what could we say the first place that we look to pass those resources if we've got those kinds of assets, Austin?
Yeah, if you've got a traditional IRA and you've seen growth in that and you're wanting to pass it on, especially if you're charitably minded, make those beneficiary designations charitable organizations because any of the growth, any of the account value, if you pass it on to a charity, they're not going to have to pay any ordinary income.
Right.
Like we mentioned earlier, if you've got a child that's in a high income bracket, they may have to pay 15, 20, 30% on those on the resources that are distributed to them. Well, if you give those to a charity instead, then the IRS is not going to take any tax from those. So we want to really think, if you're charitably minded, if you want to give resources to nonprofit institutions, do those from your traditional IRA. Make sure that those go out from there rather than taking those out from Roth or from non-qualified accounts.
And the same really can be said even during your lifetime, can't it?
Yeah.
I mean, we look at this and say, oftentimes if we've got plenty of resources in that traditional IRA and you've got a set amount that you want to give to different charitable institutions, why not start doing that via qualified charitable distributions during your lifetime, even above and beyond what your typical giving would be, because you get to see those resources get to be used. So just as a reminder, you can give up to $100,000 per person per year via a qualified charitable distribution. Now, you have to have attained that magical age of 70 and a half. So your 70 and a half birthday has to have happened to be able to start doing these charitable, qualified charitable distributions direct from your IRA over to that receiving charitable institution. But provided that that's true, one of the things that we come back to again is if you have the resources to do living and giving, let's just say that that curve is really, really strong. Your curve of retirement is upward trending. Oftentimes we want to say, well, is this in line with your core values over time? Would it be more in line, maybe even to accelerate some of that giving? And that could be to individual beneficiaries and also be to charitable beneficiaries there.
And one note with those qualified charitable distributions, if we have a husband and wife who have, maybe let's say the wife has a more significant traditional IRA than the husband, she can make the entire $100,000 for herself and $100,000 for her spouse from her traditional IRA. It doesn't all have to come. It doesn't have to come $100,000 from each of them.
Right.
It can all come from one spouse. So just be aware that you can make really substantial gifts if you are a married couple or if you're an individual to charitable organizations through QCDs. And we would highly, again, like Spencer was saying, we would highly recommend accelerating those gifts to see what does the institution do with them? What does an heir do with the resources? Because we want to pass on resources wisely.
Gives you a great opportunity for some feedback to see how all that plays out and be able to be encouraging at whatever level would be significant to you.
So the last thing we want to touch on with those traditional IRA resources is if you are a non-spousal beneficiary, think children, then you have 10 years to take out all of the account value.
Right.
So the account has to be liquidated by the 10th year after the date of death. So what that means is you are going to have to take out every year a required minimum distribution and then take the lump sum out at the end of that 10-year period. So again, when you think about passing these traditional IRA resources along, you want to think about not only the current tax status of your beneficiary, you want to think about what's their income potential over that long period of time. So that's where, again, we would say, can we accelerate that living and giving? Can we accelerate those giving to charity so that we're not passing on a significant tax burden to the next generation?
Right.
So, Spencer, the last area that we really want to touch on is the area of trusts. So what do we want to think about beneficiary designations and passing on resources in trust?
Well, we've got to be careful when we use trusts, and we don't want to really think about trusts as something that just solves different problems because there are trade-offs as we use trusts.
Yeah.
So one of the things is trusts give us this idea that we can speak beyond the grave into how resources are distributed, and they can help that.
Yeah.
But it's not foolproof. We also have to look at the assets that are placed in the trust or governed by the trust, because if we've only got 10 years, for instance, with that IRA, we want to make sure that within the provisions of the trust, we're giving latitude so that those distributions can come out over that 10-year time frame. And the expectation that, okay, if we have a really high level of disbursement, it needs to land with the beneficiary. Otherwise, if it's kept in the trust, then we're paying through the nose in tax, to the tune of 37 or 39% or maybe even more in those trusts. So we want to be really careful about that. So with trusts as well, we want to think about the assets that are located there, because it may be that we look at, say, the Roth resources and the non-qualified resources, and those resources are positioned in the trust, whereas that traditional IRA resource, maybe we just have enough there for that 10 years worth of distributions, and then maybe the remaining part goes to a charitable institution or something like that. Because trusts, again, as long as we pass all that income through annually, oftentimes trusts are not going to hurt us from a standpoint of taxation. But if we don't manage that well, it can really end up, this can be one of the worst situations where we name really the IRS as a beneficiary, in our accounts unwittingly. And that really was something that changed as well. In 2019, we used to be able to stretch these distributions over the course of a lifetime. With a traditional IRA, we can't do the same now. So we have to be careful with that. And there have been times that we'll sit down with a client who has resources that are going to be going to trust that hasn't updated, some of those provisions, having drafted that document prior to 2019. So got to be careful with that. The other thing that I think that we just really need to make sure is that we're not putting too much of our trust in trusts to be able to reform the spending decisions that maybe some of our heirs have if they're not making wise decisions. The trustee is going to make those distributions, is going to try to abide by the trust document, but there's always a level of pressure and there's always a level of interplay there. And so, there are limitations in terms of how much we can speak into those situations.
So as we close out today, what we want to come back to again is this reality that accounts are different. Goals are different. Goals for each account need to be different. So beneficiaries for accounts are different. And we want to really think critically of how we are passing on resources to that next generation, whether it be charitable institutions or people. So as you close out this video, we just want you to consider, okay, what is my specific situation? And with your specific situation, we would encourage you to bring it to a professional, bring it to a tax professional, bring it to your financial advisor, and have honest conversations of what are my beneficiary designations? Is this the best plan moving forward? Bring those things to us. If you're a client, maybe ask us to review your beneficiary designations with you. We would love to walk through that and just give counsel of what are the positives, what are the negatives, what maybe have we not thought about with these situations. Anything else you would say in closing, Spencer?
Well, it can easily be a 6-figure or more decision. Because, we think, let's just say that we had an example where we had $3 million being passed and, a fraction of that going to a charitable institution, let's say $300,000, and then the remainder being divided across 2 different heirs, very different tax brackets in there. And we have Roth, non-qualified, and IRA resources. There can be a tax difference there of something like 10% on the assets that are passed. So that might be $250,000 in there. And then let's just say there are $300,000 that's going to charity. Since there's no tax that would be paid there, if we arrange things correctly, we might be able to save something like, $70,000, $80,000, in there, just by making sure that those are pre-tax resources, IRA resources, rather than naming that in the will. So, can easily be a very, very significant sum if we just pay attention to this piece, if there are differences in terms of the tax status of our beneficiaries.
Well, thanks for joining us. Again, if you have questions, feel free to reach out to us and we will talk to you soon.
Take care.
This content was provided by Retirement Planning Services. We're in Knoxville, Tennessee, and you can visit our website at www.seriousretirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents.